Good morning, ladies and gentlemen, and welcome to this presentation of Finmeccanica full year 2014 results. I'm Raffaella Luglini, head of IR and SRI. For the presentation today, I'm pleased to introduce you to our CEO and General Manager, Mauro Moretti. He will take you through an overview of the results and the recent strategic progresses we've made. Then our CFO, Giampiero Cutillo, will take you through the full year results in more details and update you on the guidance reflecting the new shape of the group. We will then welcome your questions. I will now hand you over to Mr. Moretti.
Thank you, Raffaella. Ladies and gentlemen, I am very pleased to address you again today. It's only 7 weeks since we presented here in London our new industrial plan 2015-2019. So I'll keep my remarks brief. There are some key points for you to take away today. First, we are delivering on what we said we would do. Second, change has already been happening. You can see it in the 2014 result, and especially the second half. EBITDA above 1 billion euro, EBIT 700 million euro, and positive net result before extraordinary transactions. You can see in the new industrial plan that we launched in January. And you can see it with the agreed sale of the transportation business, meaning that going forward, we will now be a focused aerospace and defense security player. And lastly, we are very focused on achieving our target for 2015 and beyond. We achieved a lot last year as we started to turn around the company. We delivered above expectations. And we closed out the year with good momentum, finishing well above our original guidance. You know that twice we upgraded the guidance. With an especially strong commercial performance, order intake above 15.5 billion euro, and the book-to-bill above 1. Revenues close to 14.7 billion euro, and profitability at 7.4%, improved by 100 basis points year on year. We have delivered strong performances in helicopters, defense electronics and security, and aeronautics. To give you some example of operational progress across the group, in helicopters, we achieved European and US certification of our last son of the family, AW189, particularly dedicated to oil and gas services. We already delivered the first 10 of those helicopters, 189s. We expect the certification for the second important new helicopter, the AW169, and we are progressing well with the AW609. Particularly in recent months, we are already agreed with the most important companies of helicopter service for the commercial use in the future. In Selex, our airborne and space won a key contract for the upgrading of the Eurofighter radar, the ESCAM radar. Our land and naval maintained good profitability on higher volumes, and security and smart improved profitability, fully recovering from the air traffic control issue. In aeronautics, aerostructures increased production rates of B787 and ATR, while we drove volume increases in military platform for Eurofighter, JSF, and our trainer, the M346. And then we have seen good evidence of stabilization on defense electronics and security, with order no longer declining in the United States and the loss of earning in DRS on the high-carbon contract fully made up at the group level, as I committed to when I first addressed you at the first half result. We have also delivered a step change in corporate center costs, radically transforming the culture and delivering 25 million saving in 6 months. And lastly, we are improving the quality of our earnings. You know that this is a priority for me. And I am pleased that we are back in the black, delivering a positive net result before extraordinary transaction in 2014 of 70 million euro. It's the first time we have done that since 2010. And we will have a lower level of restructuring and below the line cost going forward, but we have much more to do. That was 2014. And we are already looking ahead. In January, we presented our new 5-year industrial plan. I said here that we will strengthen our business with a meaningful step up on profitability and margins by far-reaching change to our operational processes in engineering, in supply chain, and in manufacturing too. By 2017, we are going to reduce working capital by 15%. And we are going to rationalize CapEx and capitalize R&D by 20%. And we will deliver a meaningful step up in cash generation with guidance for 2015 of positive between 200 and 300 million free operating cash flow without considering the operations. Reducing debt and creating a stronger capital base. When I presented the industrial plan, I said that we will also develop this business by doing much more with less resources, increasing our focus but not getting smaller, using a sharper focus to achieve more and grow in our core with fewer products and with fewer segments in fewer businesses, whilst strengthening our commercial footprint and reach, delivering to more customers in more markets, but doing it more efficiently through standardization, modularity, and dual use. And we are confident that we can execute. Why? Because change is already happening, and since we announced our new industrial plan in January, we took another important step with the disposal of the transportation business. You remember that before there was a disposal in July of the buses sector, and this is the last part, the rail sector, both signaling and rolling stocks. The sale of the transportation business to Hitachi was a key milestone for Finmeccanica, enabling us to focus on our core business, with less than 1% of group revenues now in non-core activities. It will also make a significant contribution to reducing our net debt by around 600 million euro in 2015. And the transaction with Hitachi also represented the best possible outcome for the two transportation businesses, the two companies, and all their stakeholders and all their employees. In 2015, my priorities are very clear. The absolute first priority is the execution of the industrial plan turnaround. In order to do this effectively, we are changing the way in which we manage the business. As we have said since last year, we are transforming into one single operating company based on a divisional structure to ensure it is fit to the purpose. And this represents a strong discontinuity compared to the past. It is a radical mission change, not a symbol label change, from a financial holding company overseeing a number of diverse and not homogeneous semi-independent businesses, to one single industrial company focused only on the aerospace and defense, and selecting within each business, product, line of business, and so on. So we have now got a much more operationally focused management aimed at providing clear direction to our divisions. We are shortening the chain of command, and this will facilitate much more effective decision-making. To support this substantial transformation, we have undertaken a deep review of all the industrial processes in engineering, supply chain, manufacturing, and the full assessment of all products and line of business across the sectors, starting to exit from non-core business, as we intend to move out of areas that are no core for us or where we don't have the full industrial control within the core business. I am fully committed and personally involved in driving these material changes. Second priority, we must now deliver as focused a space, defense and security player. In January, I told you that 2015, we will be refining our go-to-market plans in each market, establishing our priority markets first, and then establishing the right customer-focused model to deliver there. As for the rest of the portfolio, the ink is not yet dry on the transportation sale agreement with Hitachi, but already people want to know what is the next. In this regard, I repeat what I told you in January in London. All of our remaining assets are important in the potential strategic development of the sector in Europe. They are important pieces on the chessboard. There are no sacred cows at Finmeccanica anymore. Every part of our portfolio must contribute. Otherwise, if more value can be achieved by an asset being outside of the group, I not hesitate. But our plan to reduce the debt is based on transformation in the delivery of cash over the next few years, not on the new business disposal. And at the moment, we are well-founded and we don't have any pressure about liquidity issues. So I won't be pressured into selling anything, and we will update you only when we have something to say. Let me finish with one simple example of how we are making the industrial turnaround of our priority, how we are taking a very different approach, and how we will ensure that we move fast and with commitment to change. We are, for example, committed to increase engineering productivity by 10% in 2015, with more to come, to be delivered by a range of action focused on R&D execution and by creating a more effective organization based on the division, giving to the line of business the opportunity to control the engineering application. A complete change in the Finmeccanica philosophy and all the philosophy of the control companies. So this is a serious turnaround plan to restore international competitiveness and create value for the shareholders. Thank you, and I hand over to Gianpiero for the detail in the financial aspect. Thank you very much.
Thank you, Mauro, and good morning, everyone. As you have heard, we have delivered results above expectations, and we have closed out the year with a good momentum. But we have got a lot more to do. And our number one priority, as Mauro just said, is delivering to the turnaround plan. I want to start with some thoughts on our overall performance in 2014. Then I want to show you the progress of our operating businesses and how they've driven this performance. And then I want to confirm our 2015 guidance and now reflecting the transportation sale. So starting with the overall group performance, a few key points. First, there has been an outstanding commercial performance with the new order over 15 billion. Good performance across the core group and supported too by transportation. Second, revenue has increased to over 14 billion, mainly driven by Selex, aeronautics, and the helicopter. Thirdly, the real good news is the EBITDA at 1,080, and it's up 23%, and we return on sales of more than 7%, helped by a very strong Q4 and improving the operating performance. Plus, we are starting to see the benefits of more cost-cutting initiatives. Business like Selex, you may remember, performed and delivered step up in profitability, and it will continue. Aerospace and defense overall was in line with expectation. And as you know, we made progress towards last year, improving the results in transportation. All this is starting to feed into better performance at the bottom line. A reduction in below-the-line items resulted in a significant improvement in EBIT. So we achieved a positive net results before extraordinary transaction with a turnaround of more than 700 million euros versus last year. And importantly, the free operating cash flow has also got better on the back of a stronger cash management in Q4. It was still negative of 137 million euro, adversely impacted by the hit from the famous Indian helicopter contract. But stripping that out, the free operating cash flow would have been positive, above 100 million, better than the original guidance. So, two important points to me from these are, first, we did better than expected in 2014, with the visible benefits from our action on cost. And this gives us confidence on the targets we have shown in the industrial plan. Let's focus on the group orders. Now, let me show how the operating businesses have driven this performance, starting, I would say, with the orders. Here you can see the really strong commercial performance that has been above the guidance, with, as we said, above 15 billion. The book-to-bill above 1 for the second year in a row. Aerospace and defense overall showed a good commercial performance, mainly in helicopter and Selex. You can see on the slide the helicopter at a good order of 4.6 billion as a result of contract with the UK MOD to upgrade the Merlin fleet, and especially a greater contribution from the product support. Selex 2 has done well, with order up 4% at 3.6 billion. Importantly, you should note that DRS order has stabilized around 1.5 billion euros. For the first time in the recent years, orders were at the same level of last year. So we believe that the decline trend has stopped. Aeronautics is also doing well if you consider that it was against a very strong 2013, which saw major order on the B-7 and Eurofighter programs. Transportation too did very well. So about revenue, at 14.7 billion, we also deliver at the top end of the guidance. Helicopter did well, continuing to grow at 4.4 billion of revenues, with the sales of the AW189, the CH-47 program for the Italian Army, and again, product support revenue. Important also, Selex revenue was up on 2013 and at 3.6, and it was in line with the expectation. We saw the increased activity on the airborne and space, and also in land and naval system. Both these areas benefit from an important new contract which we won at the end of 2013 and in 2014. DRS was lower, as expected, as planned, but we are encouraged, as we say, by the level of order intakes, so we do not expect a further decline going forward. This after adjusting for some of this business being exited. Aeronautics benefited from the growth in production rate of the B787 programs. Let's go to the EBITDA. On EBITDA, we beat our latest guidance, achieving, as we said, an EBITDA of 1,080 million euros, and as we said, has been 23% higher. And all our sector performed very well, and to achieve even a very good ROS at 7.4%. And we did this despite the problem in the air cargo contract in DRS, which impacted the EBITDA by more than $100 million. The slide here is showing a bridge between 13 and 14. Helicopter has really an impressive profitability, contributing 50% of the group EBITDA, and a return on sale which is above 12%. And the comparison with last year looks even better if you strip out the 50 million one-off benefit in 2013 from the US presidential contract. You can also see the progress in defense electronics, where the recovery in profitability in Selex almost offsetting the DRS shortfall. Aeronautics improves almost 20% year on year, thanks to the benefits of the efficiency action in our manufacturing. Defense system has maintained its profitability. All these give us confidence in achieving our target of raising EBITDA by 20% over the next 2 years, and stepping up our return on sales by more than 150 basis points, as we said in January. Going forward, transportation will not longer be part of the group, as you know, but nonetheless, we were satisfied to see a positive contribution from transportation this year after some year of losses. Turning to cash, we have seen an improvement compared both to 2013 and to guidance. I want to show you the key dynamics driving the free operating cash flow. Looking at the slide, what you see here is a very good contribution from the operations. Then there is the dividend from our JVs. In 2014, we received the payment of an extraordinary dividend, so the total item have been over and above the regular dividend flow. Then you can see a lower net investment of 620, but which benefits from around 300 million of government grants. I'll cover later how we see this going forward in 2015. You can see that despite the improvement in profitability in transportation, as expected, this sector remains a major drag on in free operating cash flow. Then finally, the effect of the Indian contract, the famous one. As a result of all of these, the net effect was a negative free operating cash flow for the group of minus 137 million. And as you can see, without the Indian contract hit, we would have been positive of around 120 million. You heard from Mauro that we are back in the black, with a positive net result before extraordinary transaction. In this chart, we would like to show the reasons. 2014, EBITDA starts up 23%, driven by higher revenue and improved efficiency. But the key point here is the lower below-the-line charges. The non-recurring expenses fall from 423 to 92. Restructuring charges fall almost 50%. And this is all in line with what we promised 1 year ago. So this leads to an EBIT up from a negative 14 to a positive 692 million euro. And then we have the financial expenses at 440 million. Taxes are slightly higher. And all this gives a net results before capital gain or extraordinary transaction positive of 70 million euros. That's, one more time, is over 700 million euro compared to the negative 649 million of last year. To me, this represents a step towards a higher quality of earnings. And as we said, improving the net results and achieving a lower volatility of earnings are key objectives in our plan. Now, I want to update you very briefly on the operating performance of the business. Starting with helicopters. As you have seen, helicopter performed very well in 2014. This again shows the strength of our product portfolio. The order intake demonstrates the appeal of the new products, 189, 169, as you have heard. Revenue grew above the market growth rates. And you can see the strong double-digit profitability. The activities on the new product are progressing well, and we remain confident in the near-term prospect to maintain a very attractive profitability. Defense in Selex, as you know, Selex is in the middle of an important restructuring. The key point is that we are doing what we said we would, and we are seeing the benefit clearly coming through. I've mentioned the increase of margin profitability. You can see the step up from 2% to 5.2%. But what's important here is that we are confident of growing further. DRS has been affected by two main items. First, the drop in volume, which we had planned for. And secondly, the famous problem on the air cargo contract. But it's an isolated one, and we have dealt with it, and you can see that the total different picture on Q4 performance. So going forward, we expect to have a recovery profitability starting from 2015. And the real good news, as we said, is that we saw the decline in order stabilizing in 2014, and we expect it to start rising again this year. Aeronautics. Here we saw a satisfactory performance, grow in revenue and EBITDA, and importantly, we are continuing to grow in return on sales. And it looks better if you don't consider, strip out the 300 million of pass-through revenues. The key drivers here were the good production performance, mainly in 787, ATR, as well as the military platform, the M346 and the Eurofighter. And management action driving profitability, really focusing on industrial processes and production efficiencies. Because of this, looking forward in 2015, we expect to continue progress and maintain profitability with some additional benefits. Space, in line with last year, let's say no surprises. And going forward, we expect to grow revenue and improve the business performance. We see the growth here in manufacturing and launch operations services. In defense system, EBITDA was down compared to last year due to MBDA and underwater system. We expect a partial recovery in 2015 and to do better than last year, with the major deliveries on the missile system and rising production. Transportation, as you can see, we summarize the results here. And given that it's not part of our future, I won't go into additional details. Now, I want to confirm the guidance for 2015. There are no significant changes to most of the assumptions that we shared with you in January, with the obvious exception of the reduction in net debt by 600 million resulting from the transportation deal. The recap, as we say in January, we are assuming a modest top-line growth, but achieving a meaningful step up in profitability of 10% in 2015. Much lower volatility in earnings and lower restructuring charges. And now, I think it's important for you to understand the key drivers and major components of our free operating cash flow and why it's improving. You can see this on the next slide. First of all, you consider as a starting point the cash from operation that goes from 725 million to almost 900 million in 2015. Then you can see the contribution from JV, I mean dividends. We are expecting only a normal level of dividends in 2015, as we won't be getting the extraordinary dividends that we got in 2014. Then we have our investment spending, which is an important driver in our cash flow. Here we are budgeting for a higher net spend in 2015, but only because we expect a lower level of government grants, which is in the range of 150 million, which is the normal level. Then in 2015, we still see some negative drag from the transportation business reduced to a 50 million and then stopping. All of this will result in an increase on free operating cash flow, which is in 2015, we expect to be in the range of 300 million euros. To summarize the guidance, we are now an aerospace and defense company. So the new group guidance is affecting the old aerospace and defense we shared with you in January, with the exception, as we said, of the group net debt. Our number one priority, we already said this, is to deliver in our industrial plan. And we have a very clear medium-term targets, significant increase in EBITDA, plus 20% from 14 to 16, and more than 150 basis point rise in return on sales. SG&A reduction over 10% over 2013-2015, 20% reduction in capital expenditure and capitalized R&D, reduction on the operating working capital, and positive and growing free operating cash flow that reduce debt to below 3 billion by the end of 2017, and a stronger capital structure with better ratios. So in summary, drawing all that together, hopefully, we have shown you that, as Mauro earlier said, we have already started to deliver on what we said we would. Clearly, there is a lot still to do, but change is already started. And you can see some of that coming through in the results that we have shown. And we are really focused on achieving the target we have laid out, and we are confident that we can do it. And with that, we can hand over to the Q&A. Thank you.